Hey everyone, welcome back to MoneyQuest Broker. Today we're diving into something brand new in 2025 that's quietly shaking up the investing world: private credit ETFs. If you've been chasing yield but are tired of the same old dividend ETFs or corporate bond funds, this is one topic you'll want to stick around for. These funds promise access to higher yield private loans that were once off limits to regular investors, all packaged neatly inside an ETF you can buy in seconds. It sounds like the perfect income solution, right? Higher yields, daily liquidity, and the credibility of big names behind them. But here's the truth: what's under the hood might surprise you. Because when it comes to private credit ETFs, the fine print is where the story really begins. Before we get into it, quick disclaimer: this video is for educational purposes only and not financial advice. I'm not your financial advisor. Always read the latest prospectus and consult a licensed professional before investing. Alright, let's unpack what's happening. Imagine being able to own a piece of the private loans that big institutions like Apollo, Blackstone, or Ares have been making for years: high yield, floating rate, direct loans to companies that don't borrow through public markets. That's what private credit is. For decades, this market was reserved for pension funds, insurance companies, and accredited investors. But recently, major asset managers have figured out a way to open it to everyone, by blending public and private loans inside an ETF wrapper. Here's where it gets interesting. One of the first and most talked about examples is the SPDR SSGA Apollo IG Public and Private Credit ETF, ticker symbol PRIV. This fund, launched in 2025, combines the power of State Street Global Advisors and Apollo Global Management, two heavyweights in their fields. According to its filings, the ETF targets between 10% and 35% in private credit, with the remainder in public, investment-grade bonds. That means it's not a full private credit fund. It's a hybrid. The expense ratio is around 0.70% per year, which is higher than most traditional bond ETFs, but lower than private credit funds or BDCs that often charge over 1% plus performance fees. What you're paying for here is access to the kind of yield that's usually behind institutional doors. And those yields have been, honestly, pretty attractive. In late 2024, direct lending strategies, which are a major part of the private credit world, reported annualized returns of around 10.5%. That's several points higher than what you'd get from investment-grade or high-yield bond ETFs. The appeal is obvious: more income, less dependence on rate cuts, and, potentially lower volatility than equities. But here's where you need to look a bit deeper. Those 10.5% returns came from funds that lock up investor money for 2 to 3 years, not from ETFs you can just trade every day. So when someone wraps private loans in an ETF, they have to make compromises. Liquidity and yield don't naturally mix. Let's think for a second about what that really means. Private loans don't trade daily. They're negotiated deals, sometimes customized for a single borrower, with valuations based on internal models, not live market prices. When you see daily liquidity on an ETF that holds illiquid assets, what actually makes that possible is the liquid portion, those public bonds, not the private loans. The more liquid bonds it holds, the easier it is to handle redemptions. But honestly, the smaller your true private credit exposure becomes. That's why you need to know the exact range. PRIV says 10 to 35% in private credit, which gives flexibility but also uncertainty. If markets get choppy, the manager might keep private credit at the low end of that range to protect liquidity, which means your yield advantage could shrink when you need it most. Now, let's talk about how these loans are valued. Unlike public bonds with quoted prices, private loans are typically marked at fair value, determined by the manager using models. That's perfectly normal in private markets, but it does mean prices can lag reality. In volatile times, the NAV you see might not fully reflect current market conditions. Liquidity is the next big question. How does the ETF pay investors who sell their shares when part of the portfolio can't easily be sold? Usually, by selling liquid bonds first. If selling pressure continues and there aren't enough public assets to meet redemptions, the ETF may start to show discounts to its net asset value. You might sell your shares for less than the underlying assets are worth simply because of liquidity stress. This isn't a hypothetical. In other hybrid funds with illiquid assets, such mismatches have caused short-term dislocations in the past, so it's really essential to check the fund's liquidity management policies. Do they have cash buffers, credit lines, or affiliated buyback agreements? Are there any redemption restrictions in extreme conditions? You can find these details in the prospectus or semi-annual reports, though, honestly, few investors ever read that far. Fees are another thing people underestimate. PRIV charges 0.70% annually, reasonable for its category, but still several times higher than the 0.05% to 0.20% charged by plain bond ETFs. If the yield advantage is only 2 percentage points, fees and valuation lags can erode much of that benefit. Always compare after-fee yields, not just gross returns. And, don't ignore concentration risk. Private loans are bespoke, meaning the ETF might have exposure to a smaller number of borrowers. If one or two borrowers default, the impact can be noticeable. That's why checking the manager's underwriting history matters so much. Apollo, for example, has 10+ years of experience in private credit, but other new entrants might not. Here's what to check before you buy any private credit ETF. First, how much real private credit it actually holds. Second, how those assets are valued. Third, how liquidity is managed. Fourth, total costs. And fifth, manager quality and diversification. If you can't find clear answers to those 5 points, that's your sign to wait. Let's compare yields to wrap it up. As of early 2025, high-quality corporate bond ETFs yield about 5% to 6%. Private credit ETFs, depending on structure and exposure, target roughly 7% to 9%. That extra 2% to 3% is your complexity premium. Whether it's worth it depends on your risk appetite and patience. Private credit ETFs are one of the most innovative products to hit the ETF world in 0 years. They open access to a market that used to be completely closed off, but innovation always comes with complexity. If you treat these funds as a small, actively monitored part of your income portfolio, they can work. But if you expect them to behave like simple bond ETFs, you might be disappointed when volatility hits. So, are private credit ETFs your income boost or a hidden trap? The truth is, they can be either, depending on how much you understand before you invest. If this deep dive helped you see the full picture, make sure to subscribe to MoneyQuest Broker. We break down the newest ETF innovations, decode complex financial products, and help you invest smarter with facts, not hype. Thanks for watching, and I'll see you in the next video.